Hello everyone and welcome to Investing by the Books, a podcast by Redeye. I'm your host Eddie Palmgren, and with me in the studio is my friend and colleague Niklas Sävås. How are you?
I'm really good. We have had summer holiday here and also a weekend now, so I'm refreshed and really excited to begin. And today we had the great pleasure of talking to Christian Billinger, the manager of Billinger Förvaltning and a contributor to Investing by the Books. Some of you listeners may remember Christian from episode 8, where he interviewed Lawrence Cunningham about his book Quality Investing. And we also did a short interview with Christian in Omaha, which you find in episode 21.
And for today's episode, our guest has selected the book Investing for Growth by Terry Smith. Here comes our conversation with Christian Billinger. Welcome to the podcast, Christian.
Thank you for having me. Pleasure to be on. I'm a big fan of the podcast, and I've listened to a number of the previous episodes. So glad to be here.
Where are you today?
So I'm currently in Karlstad, Sweden. So I spend some of my time here. I spend most of my time in London, but the company I run is still based in Karlstad, and I have family and friends here. So I've come up here with the family for a couple of weeks to work from here and to sort of holiday up here. So I'm it's great to be back here for the summer.
Okay, and let's start with the early days. How did your passion for investing start?
Yeah, so I've been investing for over 25 years now. So I started investing when I was 16 or 17, and my parents wanted to encourage myself and my sister to learn about saving and investing, and they put some money into a brokerage account for both of us. And so this was in the late 90s with the sort of dot-com bubble and everything. And that was a very exciting time to be getting into investing and probably a good time to learn about investing as well, because we got that break in the market. So that taught me a few lessons. And I've been investing ever since then. And later on, I decided to make a career of it. So first, I worked as an analyst for a number of different European equities funds. And then since 2015, I've been investing through my own company. So I guess in total, I've been investing for a little over 25 years and professionally for a little bit more than 15 years.
And for today's episode, you have chosen the book Investing for Growth. Why?
So I guess it's probably helpful if I just briefly summarize the sort of message of the book, and then I'll get to the reasons I chose the book. So it's basically a collection of articles and letters to shareholders of the Fundsmith Equity Fund. And this was published to mark the 10th anniversary of the fund. And Terry Smith, who's the manager of the fund, has a very simple philosophy, which I'm sure we'll get back to. So basically, his sort of worldview is that stocks follow earnings, and there's a small subset of great companies which are able to avoid mean reverting, at least for very long periods of time. And he basically spends his time looking for those types of businesses. He puts them on a short list, and then he waits for an opportunity to buy them when he feels the valuation is at least reasonable, if not cheap. And then he just sits there. I think it's important to sort of keep that in mind when just to sort of provide a bit of context when I answer your question of why have I chosen the book. So I think, first of all, the philosophy I just described, I really identify with the idea of owning great companies for the long run. And when I look at the holdings in our portfolio, there's a lot of overlap with Fundsmith. So in terms of names like L'Oreal and Estée Lauder and Kone, etc. I think it's a really useful book because it describes a method that many investors can replicate. You know, he hasn't generated this great track record by poking around some obscure section of the market. He's achieved all of this investing in large and well-known companies, and anyone can invest in these companies with the click of a button. Right, so he owns L'Oreal and Microsoft and Facebook and Novo Nordisk, etc. So, I think it's a really useful book. There's nothing sort of exotic or unusual about the things he invests in, and I think that speaks to his sort of independence of mind as well. He's found something that clearly works, and he doesn't really care what others might think about the method. whether it sounds smart enough or not. There's other examples of people who've invested in similarly large and well-researched businesses with great outcomes. So TCI is one example, AKO Capital is another one. And I think that's really encouraging. So that's the first reason, really. I think it's useful, and I identify with the sort of philosophy. Secondly, I think it's really fun to read. It's not an academic textbook. It's written by a practitioner, and it's a collection of articles and letters to shareholders. So it gives you this unique opportunity to sort of follow his reasoning in real time, if you will, as events unfold, as opposed to having been written with the benefit of hindsight. So I think that's great. And then thirdly, I don't necessarily think it's quite as well known as many other great investment books. And certainly when it comes to a broad audience, I don't think it's as well known. So they're probably the main reasons I've chosen that book.
And how long have you followed the work of Terry Smith?
So the first time I heard of him was back in 2004. I was doing a master's degree at the LSE at the time, and one of the books that we were assigned to read before we started the program was Accounting for Growth, which is one of his previous two books. And I immediately thought he writes in a really colorful way, and he used all these real world examples of accounting irregularities or accounting manipulation, and I thought that was a really great book. And then since then I've followed him more closely since 2010, because that's when he launched Fundsmith. I've been invested in the fund for a number of years. I read his letters and articles, and I go to the AGM and all of that. And then in 2015, he released a book called Celebrating 5 Years of Investing in Decades of Success. And that was to mark the 5th anniversary of Fundsmith. And then obviously at the 10th anniversary, he wrote the book we're discussing today, Investing for Growth. So the first book I mentioned, Celebrating 5 Years of Investing, that's sort of the first half of Investing for Growth. And then he's added another 5 years of letters and articles.
And as you said before, the book is a chronological collection of all the newspaper articles and annual letters to shareholders that Terry Smith wrote between 2010 and 2020. Do you have a favorite part?
I think, to me, Niklas, the highlight of the book is really reading all these annual letters in sequence. And we can come to some of the sort of themes. And then there's also a handful of articles that I think really emphasize important aspects of his philosophy. I think in terms of the themes from the annual letters, there's probably three things. So the first one is as you read these letters, you realize that Terry Smith is very consistent in terms of his philosophy of investing, but he's very flexible in terms of the implementation. So the philosophy is that he's always looking for these great businesses at reasonable or better valuations. But in terms of implementation, he will implement this through different types of companies over time. So, for instance, for the first 5 years of the fund, he had a very large exposure to consumer goods. In the last 5 years, he's been much more exposed towards US tech. So you see that flexibility in implementation, but he's always looking for great businesses, regardless of sector and geography and market cap. So that's the first point. The second point is that he cares about business quality above all else. So he's not saying that valuation is unimportant, but he thinks it's much less important than business quality. And there's a great quote in the book where he says, if you're a long-term investor, owning shares in a good company is a much larger determinant of your investment performance than whether the shares were cheap when you bought them. And I think that's a really good lesson. And then thirdly, he talks about minimizing turnover and costs, the doing nothing bit. So they're really the sort of three things he focuses on throughout these annual letters. And I can mention a few articles that I think are especially good as well. So there's a handful of them. The first one's called Return-Free Risk, Why Boring is Best. And that really talks about research that shows that the least volatile stocks can sometimes generate the highest returns, which is obviously in direct contradiction of what you're taught at business school and what the efficient markets hypothesis tells us. And what Terry Smith is saying is that high quality businesses tend to be undervalued, partly because investors underpay for the near certainty of returns, as opposed to the full certainty of returns that you might get. I mean, if there is any such thing as full certainty, but government bonds, I guess, U.S. treasuries might be the closest thing we get to full certainty. So he's saying investors are willing to underpay significantly for these near certain outcomes, which you find in great companies, as opposed to the full certainty of treasuries, for instance. Now, I think there's a number of other reasons why you have this phenomenon of low volatility stocks generating high returns. For instance, this idea that I think a lot of practitioners have, that mean reversion also applies to great companies even over 5 or 10 years, which clearly isn't the case, or the fact that institutional investors tend to have very short time horizons. But I think the point he makes is it's an interesting addition to that debate. Another article which I think is really interesting is one called Market Timing, Don't Try This at Home. And he talks about how market timing sounds like a great idea, right? You try and buy low and sell high. What's wrong with that? And he says there's nothing wrong with the idea, but the implementation means that almost no one is able to do it, certainly not consistently. And I think and this is something most of us, I think, have experienced, even if you do manage to sell close to the highs, often you struggle to get back into these great businesses if they ever get down to the sort of valuation that you think is attractive again. So it's a very pragmatic view of the world. And he refers in this article to a number of pieces of research, and we've all heard this many times. But for instance, if you miss out, on average, if you miss out on the best day every year for a decade in the S&P, over a number of decades, you will miss out on about half the annual returns. And so, I think his conclusion is basically that if you buy great businesses, you don't need to worry about the selling part, right? Whereas if you buy cheap stocks, you need to worry about buying low and selling high. So third example would be sorting the wheat from the chaff. And that talks about the importance of return on capital as a measure of value creation, and how important ROCE is for long-term investors. And of course, Buffett and Munger often talk about the fact that you can't really calculate the cost of capital with any great precision. But what you want to do is look for companies where ROCE is obviously in excess of any reasonable hurdle rate. So you're not looking for 10.5 or 11%, right? You're looking for something with a big buffer. And the whole point of that, according to Terry, and I agree with this, is that if you invest in those sort of businesses, the intrinsic value of your portfolio will increase every day you hold them, right? This is similar to what Buffett says, that time is the friend of the wonderful business and the enemy of the mediocre. He talks about diversification in a really good piece that is called Too Many Stocks Spoil the Portfolio. And in there, he argues that there are benefits to diversifying your portfolio, but after about 20 to 30 holdings, most of these benefits have already been achieved. So if I look at most of the quality investors I admire, they would have from anywhere from 10 to 25 holdings, and usually they would have something like 2/3 of the portfolio in 5 to 10 stocks. And I think there's a couple of issues, and this is based on Terry's discussion of this topic as well. Once you move beyond that number, the first one is that you're having to compromise on the quality of the businesses. And secondly, your knowledge of these businesses will tend to decline. And so one thing I've often done, for instance, is to invest in 2 great companies in very attractive industries, because you can reduce company-specific risk, but you have synergies in terms of researching and understanding the industry, whereas most mutual funds might own 80 to 100 stocks. And I think that's just an extraordinary number, right? I used to work for someone who said that that kind of portfolio is a case of product management as opposed to money management. And I think there's so much truth to that. So just two more examples of articles. There's one which is called Why It Is Safe to Pay Up for Quality. And that refers to this very long-standing discussion about whether high-quality businesses are generally fully valued or overvalued. And this is certainly, we've seen this topic has been very hot in the last few years. It's interesting when I read the book, Investing for Growth, because when you go through the annual letters of Fundsmith, it turns out that Terry received those sort of inquiries from investors every year since 2012, right? So in the 12 letter, the 13, 14, 15, 16, 17, 18, and 19 letters, and that's as far as the book goes, in every single one of them, he justifies his philosophy and way of investing because he's getting so much grief from investors over valuations. And I don't think his point is to say we shouldn't care about valuations at all, but I think he is saying that truly great businesses can justify valuations at much higher levels than most people would think. So if you look at the Fundsmith portfolio over the 10 years, or I guess it's now up to 12 years in existence, it's always been valued at a significant premium or a premium to the market. And it's consistently, apart from in the last 6 to 12 months, it's consistently outperformed the market. And what Smith talks about is this idea of a justified PE, which is the PE you could have paid for a stock going back 20, 30 or 40 years and still beaten the market. And for the kinds of businesses we're talking about here, like a L'Oreal, often these stretch into the hundreds. Now, obviously I'm not, and I don't think Terry would advocate paying those sort of multiples either, but it does give you a bit of comfort around the fact that if you identify the great businesses, then valuation is less important. Now, of course, I do buy the argument that you can't know beforehand how great the business will be, so you don't want to be paying 70 or 100 times earnings, right? But you can certainly pay a meaningful premium to the market if you have good reason to believe it's an outstanding business. And then just final example is an article called 3 Steps to Heaven, where he lays out the philosophy of basically buying good companies, not overpaying, and then doing nothing. And like so many good ideas in the investing world, it's a very simple set of rules, isn't it? You buy companies with sustainably higher returns on capital. You try and not overpay so that you, as an outside investor, also benefit from that value creation. And then you leave compounding alone to work its magic and without incurring any additional costs. So they're probably the examples I would highlight. There's many others in there, but I think the annual letters and a handful of the articles will give you a really good feel for what the book is all about.
I think it's striking when you describe this, and also from reading the book, how Terry Smith's philosophy and Warren Buffett's philosophy are quite similar, but they are not the same. And it's interesting where I think in a few examples, Terry Smith takes up, for example, Tesco and IBM when Buffett has invested in them, and really breaks down why he don't think they are really of the quality that he likes. Maybe you can, because I know, you're a huge Buffett fan as well. Maybe you can explain for our listeners how similar or not similar Smith's and Buffett's styles are.
So in many ways, I think when it comes to Berkshire's portfolio of listed investments, it is a very similar sort of mindset and philosophy. Now, of course, Berkshire also holds fully owned businesses and an insurance operation, and they're obviously very different animals. But I think in terms of the investment portfolio, it's very similar in looking for great companies, not overpaying, and then doing nothing. Obviously, there's differences in terms of the geographical mix, although Fundsmith has a very large US exposure, and there's also differences in terms of industry exposure. Terry's been very he's been shifting the portfolio towards US tech in recent years. But I think there are probably, to my mind, more similarities than differences. The examples you mentioned there, Niklas, in terms of Tesco and IBM, I think focuses on this idea of return on capital employed, and Terry obviously feels that you should be spending much more time on return on capital employed than on EPS growth. So I think in principle I agree with him, and I understand the point he's trying to make, but I do think that ultimately they should be a reflection of the same thing if you look at this over a long enough time horizon. So just to sort of refer to the Tesco case, there's a chart in the book where Terry sort of graphs Tesco's EPS growth on the one hand, and it's been had at least at the time been trending up for, I think, growing in the low teens for a long, long time. At the same time, return on capital employed was in steady decline from around 20% to just over 10%. And so Terry's arguing, look, they're having to deploy more and more capital at lower and lower rates to generate the EPS growth. So in principle, I agree with him that return on incremental capital is the sort of variable you want to look at. But I don't fully agree with, actually, in this case, with his interpretation. So first of all, adding more capital to the business can still be accretive as long as the returns are well in excess of the cost of capital. And you obviously need to look at returns on incremental capital. Now, in the case of Tesco, I think he's right in saying that returns on incremental capital were also meaningfully below 10% for a period of time. Fine, but I think in principle, that's important to remember. Probably more important is the second point, that over time, and this is over a very long period of time, I would assume the two should converge, right? So if you look at return on capital, which uses EBIT in the numerator, that reflects returns both to the debt and equity holders of the company. And so if you want to go from return on capital to earnings growth, you also need to look at the reinvestment rate. So that's the proportion of cash flows or earnings that you can reinvest in the business to generate future earnings. EPS, on the other hand, that should be a product of those two, right? Where the numerator is the earnings after interest, and the denominator is the share count. So the numerator, obviously, if you add more debt to the business, return on capital would decline, assuming unless you can invest it to sort of improve and grow the business. But let's assume in the short to medium term you don't. Then if you're adding debt, your ROCE declines, but so would the EPS, right? Because you're paying interest on that debt. And if you add more equity, then when you look at the denominator of the EPS sort of calculation, that will have a negative impact on EPS, right? And it will also have a negative impact on ROCE. So my point is that EPS actually reflects both the returns and the reinvestment levels, and ROCE only reflects the returns. So my issue with EPS is more that it's very slow to reflect any the impact of capital allocation decisions by management, but that's the case for ROCE as well. EPS can be misleading if you're taking on lots of leverage at very low interest rates, right? So you're boosting the EPS number short term, and then you see an increase, as I'm sure we will now over the next few years, depending on how long and for how long and how high rates go. But we could very well see this for companies that have been leveraging to sort of buy back shares, etc. But once again, that's the same thing for ROCE. If you're taking on lots of inexpensive financing, borrowed money, then you'll see a similar impact. So I think ultimately it's a valid point, but I think in reality the important thing is to understand the sort of dynamic between these two metrics, right? Both return levels and reinvestment rates. I think the reason EPS is still so popular is because it's easy to communicate, right? And I think for high quality companies, it's also highly relevant. I think his point is valid, but I think if you're looking at these large, long-established, great businesses. I think the difference between the two, or that distinction, is often overdone.
And touching on the reinvestment point, Smith is writing that this is one of the greatest risks for fund managers, that management fails to deliver high returns on capital on those retained earnings in the company. But I mean, if you own the whole company, then you have control over the reinvestment. But for minority shareholders, and what do you think they can do to reduce the reinvestment risk in these public companies?
Yeah, that's a great question, Eddie. I think there's a few things they can do. First of all, you probably want to invest in great companies, right, where there's a long track record of high returns and shareholder value creation. So you're looking for a great paper record. Second thing you can do is look at the shareholder register and try and find high quality investors. So Larry Cunningham's doing an interesting is doing interesting work on this at the moment through something he calls the Quality Shareholder Initiative. So, for instance, if I see Berkshire or Markel or Fundsmith or Lindsell Train on the shareholder register, I'll be very comforted, right? Because I'll assume I wouldn't rely on them to have done the due diligence, but I will assume that they encourage good behavior and good capital allocation, and that they will make sure that minority shareholders are treated well. So that's the second point. And then thirdly, you probably want to consider liquidity. You know, in case you get things wrong, you want to be able to sell and limit your downside. So I think they're the three things I would look at primarily.
Right. And another great article in the book that Smith has written, it was published in Financial Times in 2012. It's named Lessons from Tour de France. So what can we learn from the tour when it comes to investing?
So in this piece, he talks about how different investment strategies are built for different types of market environments, and which also means that in some market environments, you will inevitably underperform if you apply a consistent methodology, right? There's possibly some famous exceptions to this, like Jim Simmons at Renaissance and a few others. But I think the issue with that is that first of all, I don't think they're replicable by the vast majority of, or almost all the other investors. And secondly, they're not the way you invest or operate if you're a long-term buy and hold equity investor. So the idea of this Lessons from Tour de France piece is, and I think the reason he's written it is partly because he's a very keen cyclist, is that the analogy to the Tour de France is there's no rider that has won the tour that has ever won all stages of it, right? So they tend to specialize in mountain stages or flat stages or the time trial. And similarly for fund managers and investment styles, they will work in certain environments and not in others, but they may still, produce a sort of highly competitive return over the long run. I don't think he's saying we shouldn't measure fund returns or share price, total shareholder returns, etc. I think he's just saying that we need to understand that sometimes you will underperform, if you're applying a certain investment style consistently. And if you don't underperform, you can expect to outperform, and you should probably go into an index fund or something like that. So, the opposite of that would be people who rotate between sectors and or styles, between value and growth, and people who sort of market time. I don't attempt to do any of that, and neither does Terry Smith. And I think the Tour de France piece is a good illustration of that.
And talking about the debate about value versus growth, Smith touches upon that as well, and uses the term value investing to describe deep value plays and cigar butts, for example. And if we stick to his definition of value investing, what's his main critique against it, and also about special situations?
Yeah, so he takes a view, I think, which is similar to Buffett's once again, in saying that growth is simply a component of value, right? So all intelligent, I think Buffett says this, all intelligent investing is value investing. And when Smith talks about value investing in the traditional sense, I think he's arguing that the valuations are often, or usually, or almost always low for a reason, right? So they're usually a reflection of low quality when it comes to the business model or the balance sheet or the returns on capital or a combination of all these. And now, of course, value stocks will have their day in the sun, as we've seen over the last number of months. And we've seen that before, and we'll see it again. But the issue, Terry argues, is that over time, shareholder returns should reflect the returns of the underlying business. And on that basis, almost by definition, value stocks should underperform if you look at very long time frames, right? And now I'm talking decades as opposed to 3 or 5 or 7 years. I don't think it's fair to say that buying value stocks is a bad idea as such, but it doesn't suit if you're long term and you're low turnover like Fundsmith or like ourselves, given that we're trying to benefit from those returns of the underlying business. For me, it's also a question of this idea of investing in high quality assets is also a question of downside protection and risk management. And it's just more fun, right? You're invested in these great businesses for years and decades. And I just find that much more satisfying than jumping from one investment to another.
Yeah, it's very time consuming and also very costly in the transaction fee to be jumping
Indeed.
around. I mean, you touched upon the turnover, and Smith, he says that he would prefer to have 0 turnover in the fund, and partly that is because he wants to minimize the fees, but he also explains in the annual letters why he has sold certain holdings. So what are your key takeaways from The Art of Selling?
Yeah, so he has a very low turnover. Usually it's below 5%. And he's clearly a big believer in Peter Lynch's, mantra of running your winners. And I hear that from almost all the great investors I admire, that their biggest mistakes have been selling out of great businesses far too early. So there are cases when he would sell, and, I tend to agree with these. The first one would be a deterioration in the business. So he sold out of Kimberly-Clark, for instance, back in 2011. And the reason he said at the time was because the return on incremental capital was in decline and he felt the business was on the wrong path. And so he sold out. The second one is valuation. He sold out of SGS, for instance, the testing company, and he sold out of Domino's Pizza, although he later bought it back. I think he feels the first reason, so the business, the deterioration in the business is much more valid as a reason for selling than the second one, the valuation point. And there's a quote in one of the letters where he says that almost every time we sell a position in a quality company, we get to regret it in terms of subsequent share price performance. I hear this idea of never selling great businesses from a lot of experienced investors, and it seems like many of them progress from selling on valuation to selling on deteriorating business performance over the span of their careers. And as I mentioned, I agree with this notion. We also only sell if, 1, the business deteriorates, or 2, we learn something new about the business which we didn't know previously, but which means that the quality isn't perhaps quite as high as we thought. Very rarely may we sell because of opportunity costs, right? Where a more interesting opportunity has sort of presented itself, or even less common on valuation grounds. But I just find that usually if you find these great businesses, you want to leave the great forces of compounding alone to work their magic.
I think Terry has a list of about 50, 60 stocks that he's following, which is his universe of potential companies that he wants to invest in. Do you have like a similar approach, or how big is your watch list?
Yeah, it's very similar. So you're right. In some of the annual letters, he refers to the investable universe. I think in the early years, the number was sort of in the mid 60s, and then, that's slowly expanded a bit to maybe 80 or so. And we have currently about 50 stocks in our investable universe across a number of sectors and geographies. We hold about 20 of them, and the other 30 may move into the portfolio at some point, depending on, do we know the business well enough? Are we sort of comfortable on all the important aspects of the business and the investment case? And of course, valuation matters, right? So even if business quality is more important than valuation, I'd rather buy these great businesses, say in March, April 2020, or during the first half of this year, that we've seen opportunities and we've bought into some of the things on that list. So yes, I think it's a very similar idea. And, most of your time you spend just maintaining that list, adding to, sometimes removing from the list, and occasionally moving something from the list into the portfolio and vice versa.
And how do you deal with, because it's quite interesting that the stocks typically in the universe you're talking about, they are not typically as volatile as the rest of the market, mainly probably because they are really stable businesses and have been growing for a long time and with profitability. How do you think, because as you mentioned, Smith moved into this US technology stocks, which have been growing a lot and have been fantastic investments for a long time. But now we have seen quite a big turn in the market, and the volatility really shows up now with holdings such as Facebook. How do you think Smith deals with that?
Do you mean how he deals with, like, how he's able to sort of consistently outperform, Niklas, or?
No, so yeah, to be clear in that is, if you have that group of companies and you typically, maybe as you said, you want to add to the ones that are priced lower, and with technology stocks, of course, the environment changes more quickly, and it's maybe a bit harder to understand if the multiple has gone down because of actual problems or if it's just because they are not liked at the time.
Yeah, I get your question. I get it. No, that's a really good question. I actually asked Tom Gaynor this once, and he said, you can never know. You can never be sure. You just work, and you try and hopefully now and then you'll get it right. I think one thing is that Terry tends to focus on these large, long-established businesses with great track records, which I think reduces the likelihood that he's buying into a sort of subpar quality business, right? Usually there's a few different reasons why you may get the opportunity to buy these kinds of businesses at an attractive valuation. So one of them would be a company-specific issue. So they bought into Facebook, or now Meta, I think back in 2018 when the whole Cambridge Analytica story came out. So that's one type of situation. I find that to be the most difficult because of what you just said, Niklas, that it's in those situations it's difficult to determine whether you're actually buying the same business at a lower valuation or whether the business has changed fundamentally and the valuation is just a reflection of that. So I find that to be the most challenging type of buy, and I generally stay away from it, although not always. There's a couple of
maybe if I can just chip in there. I think one thing I'm thinking about is that many of the businesses in this group have been around for hundreds of years. Some of the companies I know in your portfolio has been around for a very, very long time. And for example, Facebook has been around for less than 20 years and PayPal a bit more than 20 years and so on. So it's just a different type of animal in my view.
I agree with you. So I have to say I agree. Now, it should be said, we don't really, we haven't really invested in many of the sort of types of companies that Terry has invested in the last 5 years. We've tended to stay away from them. Terry always used to report, and I think he still does this, the average age or life of the companies in the portfolio. And I think it's quite interesting that in recent years, he's obviously shifted the emphasis somewhat to companies with a shorter track record like PayPal and Meta, etc. So I agree with you there. I'm not saying that you should never look at those types of businesses, but I think for what we're trying to achieve, I'm less comfortable with that. I should say there's a couple of other situations when you may be able to buy these businesses at a fair or attractive valuation. So if the first one was company-specific issues, the second one would be a general market sell-off. I find that's usually the most appealing to us. That's usually when we tend to be most active. So, spring of 2020 or first half of this year, because often it's to do with macro or interest rates or things that are separate from the business or partly or largely separate from the business we're looking at. The third one might be a sort of rotation in the market, which we've also seen in the last 6, 9, 12 months where, for instance, higher interest rates mean that the kind of companies that Fundsmith owns and actually to a large or to some extent the kind of companies we own, or some of them like an Estee Lauder or L'Oreal or anything that's rated at a meaningful premium to the market, is sort of impacted disproportionately. And that can also create an opportunity to buy into these companies at an attractive valuation. But so I think they're probably the sort of 3 different types of situations when you may actually be able to act on buying something from that investable universe or shortlist. But I agree with you there. I also find it much more difficult when it comes to businesses with a shorter paper record.
I mean, it was not meant as criticism. It was more it's interesting to have both of those kind of animals, as I refer them to, in the portfolio, and how do you allocate between the two, and how do you think about the investments, maybe more importantly, because I think you need to think about them completely differently and be much more aware maybe about what's happening in the competitive landscape and so on in the technology group, and maybe not as much in the other group, I can think.
I agree with that. And it's interesting because, somewhere in the book, Terry talks about this idea of investing in I think he says, I'm often asked, how do you pick the next big winner? And he says, we're not. We're looking to invest in companies that have already won. But I have to say, in the last 3 or 5 years, he has somewhat diverged from that. Now, obviously, you could argue that companies like PayPal and Meta have already won as well. But I guess it's just that it's not sort of black or white here. It's a sort of there's a big range of different types of situations. But I agree. There's clearly he's shown himself to be very pragmatic, and he's been able to sort of change the way he implements this idea of owning great companies, which I admire. I mean, we haven't done it to the same extent, and I see others who haven't. I look at a Tom Russo, for instance. He's done some of that, but not nearly as much as Terry. And I think there are, I guess it comes back to this idea of being true to who you are as an investor and as a person, right?
Yeah, definitely.
So let's move over to your life as an investor, and we already touched upon it, your fund and your style. And in the foreword of Investing for Growth, Lionel Barber, he's the editor at Financial Times, he is describing Terry Smith as a fiercely competitive person, and this is a trait that, for example, Richard Lawrence also highlighted about himself in episode 25 when we spoke to him. How would you describe yourself?
Well, I think as opposed to Terry and Richard, certainly not as a fiercely competitive person. I think, I'm really more focused on the process of analyzing these businesses and less on relative performance, at least in the short to medium term. I think it's partly also because of the way we're structured, right? I don't have any external investors, so I don't need to worry about short-term performance. Obviously, in the very long run, you have to worry about it as a form of scorecard. But a few other points, I would say, like I'm sure most people you speak to, I'm obsessive about investing, and I really care about the process. I think the way I invest, like for most people I see who've been in the industry for a long time, is really a reflection of who you are as a person. So, for instance, I'm in terms of the portfolio, I'm long term. We have low turnover, and I think it's a reflection of my personality. When any type of decision, I usually take my time and I usually research it extensively. Whether it's buying property or deciding where to go on holiday. And I think another important aspect is that I tend to worry, whether it's generally or specifically when it comes to investing. So, when I invest, I worry about what can go wrong. I look at downside protection first, and I look at upside opportunity second. So that could be owning great companies, not using leverage, diversifying to some extent. And I think I'm pretty pragmatic. I try to look at what works for me, and I identify with this idea I think Tom Gaynor expressed when he said he's a satisfier, not an optimizer, right? So I think for me, doing unexceptional things consistently for a long period of time is the way to go. I'm not looking for these great home runs. I'm looking for great businesses at reasonable valuations, and then if I can do, double-digit returns over long periods of time, then I'm really happy with that. And I remember there's a line in the book from Terry where he says that at Fundsmith we obtain excitement not from the delusion that we have discovered an investment that no other investors have found, or from a long shot winning, but from delivering predictable superior investment returns. And I think that's really the way I try to operate. So I think there's some of the points that I think, they apply to me both as a person, as a human being, and as an investor. And I think when I look at the great investors over their careers, they seem to sort of mature into a version of, the investor version sort of converges towards the human being they are, if that makes sense.
And are there any challenges, like with your personality and as an investor?
Well, I guess one could be, for instance, that if you tend to worry about the downside, you may not, you may be sort of slow in getting exposure to the latest hot thing, right? To the most exciting growth opportunities. So I sometimes, and I constantly sort of try and challenge myself on this, and the directors I have on the board of the company, I ask them to challenge me on this idea that, should we have more exposure to US tech, for instance. We've had that, maybe not so much now, but certainly over the last 5 years, we've had that conversation. We're largely exposed to consumer goods and industrials. So I think that's one challenge that may in fact be the most significant one. And of course, if you're very long term and you're sort of slow to move, that may also mean that you're late to catch on to some sort of trends and the latest developments in some ways. But I guess at the same time, I think it's manageable because, that's not really what I'm trying to do. As Terry said at some point, we're trying to look for companies that have already won, really, and we try and buy them when the odds are in our favor.
And talking about this constant worrying, what kind of mistakes would you really punish yourself for having made?
So generally, I always say it's too early to evaluate whether it's a success or a mistake, right? I've only been investing this portfolio for 7 years now, which in my mind is a pretty short time span. But there are holdings in there that we feel have disappointed. So one example is Kona and Schindler, the elevator companies. And clearly I think they're great businesses, but the Chinese construction market has turned down significantly, and I think it's had a big impact on the businesses, but it's had an even greater impact on investor sentiment, especially for Kona, because China has been a clear growth driver for them for a long time, and it accounts for a large proportion of their earnings. So in that case, we sort of always knew that the market would have to slow down at some point. But it has been disappointing to see that earnings have gone nowhere for almost a decade, or certainly for 5, 6, 7 years in those businesses. So sometimes that can be frustrating. I would say, though, that although it's been a disappointment, we've managed to avoid losing money on those positions, or significant amounts of money. And that comes back to this idea of downside protection, right? So I find that encouraging. And then secondly, my view is that it's probably a cyclical issue rather than a structural issue, and I think they remain great businesses. But they're the kind of things that perhaps frustrate me. I think the other thing would be selling out of great businesses too early. I mean, I think you probably hear that from almost anyone who's a long-term, quality-minded investor, that that's really the sort of frustrating part.
And can you give an example of like one of the best investments and what you have learned from that?
Yeah, once again, I think it's probably too early to say if they really are great investments. You know, it's only been 7 years, and I always say there's always plenty of time for things to go wrong. But if I look at what's worked for us so far, it's really been the truly great businesses. And so one example is spirits companies. So we own Diageo, David Campari, Remy Cointreau. We've owned them for a number of years, and they continue to grow organically. They make interesting acquisitions. They improve their profitability, and they've also shown to themselves to be very robust throughout the pandemic and the inflation sort of pickup we're seeing now. So 2020 and 2021 were great in stress testing some of these companies, and the spirits companies came through incredibly well. And I would argue that our holdings in LVMH and Hermes have done similar things. So it's really been it's really been a case of buying and owning these great businesses.
And I think going back a bit to the discussion about investment philosophy, I think at Redeye we have a similar investment philosophy as you have, but we are working in an ecosystem which is quite different. So we follow typically smaller and businesses with high growth rates, and I mean, it's of course more uncertain on how the economics will progress with gross margins, free cash flow, and return on capital employed. Many of these businesses are quite early stage, and you have to more or less bet on how the margin profile will look when they are more mature. But of course, if you're right, you have a home run. So it's the same philosophy, but when we have these different types of companies, of course, you need to think about it quite differently. We touched upon it when discussing Meta and PayPal, for example. But what would make you comfortable buying a company that is not as mature as the companies you mentioned?
So, in principle, we can buy these small companies, Niklas, and we have done so in the past on a few occasions. But I'm more comfortable with the mid to large cap segment, partly because I've spent most of my career covering those sort of companies, and I think partly, it's partly a personality thing. I like looking at businesses where I get great access to information, whether it's annual reports or sell side research, selectively, of course, and expert networks, etc. And that's much harder when you're looking at smaller companies. And I just quite like operating in that environment. I would also say I wouldn't necessarily label most of the holdings in our portfolio mature. They're relatively large companies often. They're sort of, compared to Fundsmith, we have a smaller average market cap. So we're probably the lower end of my portfolio is probably at around 10 billion US. But still, but what I do see is they have organic growth rates that would typically be, say, 4 to 8%, sometimes a little higher than that. And underlying earnings tend to be growing at 10% plus over very long periods of time. So with the hurdle rate of 10% or so that we operate with, I don't really feel I need to go any further out on that risk curve to achieve the sort of goals. Now, obviously, I'd like to do 12 or 14 or 15%, but I don't, that's not my planning assumption, and that's not my hurdle rate. And I think it's also a case of, almost by definition, if I'm looking for great companies with long track records, often they're already relatively large companies, right? If you've been a great business for long enough, then you're probably already a meaningful, at least, market cap. And I just really like being invested in those sort of companies. I'd rather earn 10% doing what I'm doing now than 12% buying and selling some low quality sort of commodity type businesses.
And to conclude this part of the interview, what is your long-term ambition with Billinger Förvaltning?
So it's pretty simple in a way. I'm hopeful that we can compound the capital in there at double digits, at least for the very long term, with limited downside. And then being a true family business, the ultimate goal is obviously to develop and grow the whole thing so that you can hand it over to the next generation 30 or 40 years down the road, hopefully, and feeling happy with what you've achieved and leaving a meaningfully more valuable business. So that's, in a way, it's as simple as that. Obviously, a lot of things go into that. The other thing is I want to have fun in the process, right? The money is important and the scorecard is important, but because you want to be able to live a good life and you want to be able to sort of you want feedback on what you're doing, but the real reward is getting to do something you love, right? I can't really imagine doing anything else.
And another thing I know that you love is reading books. Can you mention one or two titles that you think are underrated among investors?
Yeah, sure. So I think in terms of a toolbox, analytical tools, I would recommend Quality Investing by Cunningham. Obviously, we covered that, as you mentioned, on, I think, episode 8 back in November of 21. But I think it's such a great book because it covers both the philosophy and the implementation of investing in great businesses, similar to, and actually it's written with, Cunningham wrote that book together with a couple of guys from AKO Capital. So similar to Terry's book, it's also very practical, and there's lots of case studies in there. I think that's a great book, and I think it's and the examples I've picked. I try to think of books that I think are underrated because, of course, I also love all the usual suspects. The other one is Capital Returns. I'm not saying it's undiscovered, but I don't think it's widely read. And the format of that book is similar to Investing for Growth. So it's a collection of articles by investors at Marathon Asset Management. But what really makes it different is that it spends most of its emphasis on the supply side of the equation. So understanding the inflow of capital into various industries, which is critical if you want to understand how durable returns are. So there are two books I would recommend: Quality Investing by Cunningham and Capital Returns by the Marathon team.
We'll put that in the show notes.
Thank you, Christian, for coming on the podcast and sharing your thoughts on the book, Investing for Growth, as well as your investment style. Do you have anything else you want to add?
Well, I just want to say thank you for having me. I think you're doing a really great job with the podcast. I've listened to many of the episodes I recently listened to Richard Lawrence. I listened to Chris Mayer. I think they were superb. And I like the fact that unlike a lot of other investor podcasts, it really is one for the nerds, which is my sort of thing.
And lastly, where can our audience follow you? And thank you, of course, for all those kind words.
No, thank you. Yeah, so they can follow me through our website. So it's billingerforvaltning.se. And you can subscribe to a newsletter there. And you can also find us on LinkedIn. And of course, if anyone's interested in discussing great businesses, I'd be delighted to.
Perfect. Thank you.
Thank you.
Thank you for listening to Investing by the Books, a podcast by Redeye. Follow us on Twitter at @IB_Redeye and email us at ib.podcast@redeye.se. To improve, we'd love to hear your feedback, so please rate and review us. Notice that the content in this podcast is not and shall not be construed as investment advice. This information is meant to be informative and for general purposes only. For full disclaimer, visit redeye.se. I'm your host, Eddie Palmian, and until next time, I sincerely wish you the best of luck on your journey through life and investing.